Welcome to the Deep Dive. We're here to cut through the noise and pull out the key insights you need. And for this deep dive, we are zeroing in on Tesla, specifically their latest Q2 2025 earnings. What's really interesting here is this tension. You've got headline numbers that looked, okay at first glance, maybe even a beat. But then underneath that, there's this pretty dramatic contraction happening in their core business. Management even called this quarter a seminal point for the company. That's a strong phrase.
It really is, and that's exactly what we want to unpack today. What does seminal point actually mean for Tesla right now and for its future? They're trying to make this huge shift, right, from being mainly an EV and energy company to becoming or trying to become a leader in AI, robotics, all those related services. So we'll look at what the numbers really tell us about that, that pivot.
Okay, let's dive right in then. The surface numbers, total revenues, $22.5 billion. That just slightly beat the consensus forecast. And non-GAAP EPS, that's adjusted earnings per share, came in at $0.40. Matched analyst predictions. So you might think, okay, steady as she goes.
Well, not exactly. Those headline figures, yeah, technically a small beat, but they really did mask what was going on underneath. When you actually, peel back the layers a bit, you see a pretty big year-over-year contraction. Total revenue actually fell by 12% compared to this time last year.
12%.
And GAAP operating income, that plummeted over 40% down.
Wow.
But maybe the most striking number, free cash flow, FCF, it just collapsed, down a staggering 89%, just $146 million left.
89%.
Now, I should say there were some improvements from Q1 2025, which was admittedly a really tough quarter for them. Revenue and income were up sequentially. But that year-over-year picture, that really tells a story.
So what caused it, this really sharp erosion in profits and cash from the core business? Sounds like multiple things hitting at once.
You got it. It's like a pincer movement, squeezing profitability from both sides. So first, the top-line pressures. Fewer vehicle deliveries than last year and lower average selling prices, ASPs. Plus, those regulatory credits. Revenue from those kept falling, which everyone expected, but it hit its lowest point in over a year, $439 million.
Right. Those were always temporary, a nice boost while they lasted, but not the core business.
Exactly. But then, layer on top of that, rising costs. Input costs. The CFO specifically called out tariff-related costs, up about $300 million just from Q1 to Q2.
That's from tariffs.
Yep. And about two-thirds of that hit the auto segment directly, and they warned more increases could be coming. And then the other side of the pincer. They're spending more. Operating expenses grew. Why? Well, strategic investments. Ramping up R&D for AI, more stock-based compensation, and crucially, significant depreciation costs from all the new AI compute gear they're buying.
Okay, so let me see if I've got this straight. You've got fewer cars sold at lower prices, shrinking credits, external costs like tariffs going up, and internal spending on future tech going up. That's how you squeeze operating income down by over 40% year over year. It all just adds up.
It really does. It paints a pretty stark picture for the profitability of the core auto business right now.
So that free cash flow number, down almost 90%, it begs the question, where did the money go? If they made $2.5 billion in operating cash.
And this really highlights a very clear, very deliberate strategic choice they're making. That $2.5 billion in operating cash flow, almost all of it was immediately consumed by massive capital expenditures. CapEx. They're guiding for their full year 2025 CapEx to be over $9 billion. $9 billion.
And that's going into?
It's going into building out these huge AI compute clusters, buying tons of those NVIDIA H100 and H200 GPUs. It's funding R&D for Optimus, their humanoid robot project. And it's getting ready for new product lines down the road.
So what you're saying is they are consciously deciding to funnel almost every single dollar they generate from operations right back into building the infrastructure for this.
Well, it's a long-term, high-risk bet on autonomy and AI, isn't it?
That's precisely it.
Which leaves very little wiggle room financially in the near term. That might make some investors a bit nervous. I did also spot a little non-operational item, that $284 million gain on their Bitcoin holdings from mark-to-market accounting. Interesting, but yeah, not core operations.
Right. A side note, really. The main story is that strategic CapEx decision, funding the future, potentially at the expense of near-term cash flow. Okay, let's pivot slightly to the operations side, production versus deliveries, because there was a gap there. They produced over 410,000 vehicles in Q2. That's basically flat compared to last year. But deliveries, only just over 384,000. That's down 13.5% year over year. And I heard that's actually the worst year-over-year delivery drop they've ever had.
Yeah, that's a significant gap. It means they added over 26,000 cars to their inventory in just 3 months.
But hang on, this wasn't just demand falling off a cliff, was it? There was talk about this being a strategic move, a pull forward, something to do with that big U.S. federal EV tax credit, the $7,500 IRA one ending at the end of June.
Exactly right. Management was pretty open about it. They deliberately focused on selling the existing, more expensive models that still qualified for that credit before it disappeared.
So grab the higher revenue while you can, basically.
It's a gamble, though. Maximize the revenue right before the deadline, sure. But the risk is you create this demand air pocket right after. Demand could really soften in Q3 now that the credit's gone.
Makes sense. And how does this tie into their new models?
Well, it connects. They mentioned the production ramp for their new lower-cost model, which started in the first half of the year, is now going to be more slowly than initially expected in Q3. Maybe because they shifted focus to the credit-eligible cars in Q2, or maybe other reasons. Meanwhile, that purpose-built robotaxi, the Cybercab, they're aiming for volume production in 2026. Still a way off.
Which brings us neatly to the whole autonomy story. This is central to that seminal pivot narrative, isn't it? They really want to be seen as an AI company, not just cars. And autonomy is key. They talked up the robotaxi launch in Austin. Paying customers, no driver. Expanding the service area.
And it's not just Austin. Musk laid out this, well, exceptionally aggressive expansion plan. The goal, he said, is to have autonomous ride-hailing available to, and I quote, probably half the population of the U.S. by the end of the year.
Half the U.S. population by December.
That's the claim, targeting places like Nevada, Arizona, the Bay Area, Florida. It's ambitious, is putting it mildly.
And then beyond that, the idea is personal Tesla owners could add their cars to this network confidently next year. What about FSD itself, the full self-driving software?
They reported some positive signs there for the supervised version 12 in North America. Subscription rates are up 45%, penetration, the percentage of cars with it, up 25%. So momentum there.
There's a sense of but.
But internationally, it's a different story. Significant frustration. Musk himself described the EU approval process through the Netherlands regulators as quite Kafkaesque.
Kafkaesque, meaning bureaucratic, confusing, maybe pointless.
Pretty much. And he mentioned ongoing regulatory challenges in China, too. So big markets where progress is slow or stalled. And this is where you see a potential disconnect, right?
Yeah.
Promising robotaxi coverage for half the U.S. in 6 months is huge. But getting regulatory approval, state by state, city by city, that's slow. It's outside their control. If they miss those incredibly bold timelines, it could create a credibility issue.
Okay, so huge ambition for the future, but let's pull back to the present again, the core auto business. You mentioned that pincer movement. It sounds like it's facing a perfect storm of headwinds right now, especially in the U.S.
It really is. 2 big ones you just can't ignore. First, that IRA EV credit being repealed, gone. That's effectively a $7,500 price hike overnight for U.S. buyers on eligible models. That has to dampen demand, right?
I certainly think so.
Second, those rising tariffs we talked about, that's a direct hit to their cost of goods sold. It just eats into the profit margin on every affected car they sell.
So they're squeezed. If demand drops because of the credit repeal, do they cut prices to stimulate it? But if they do that, with tariffs also hitting costs,
their margins get squeezed even harder. Or they hold prices, absorb the tariff hit, and likely see lower volumes.
It's a tough spot. No easy way out of that pincer, it seems.
Not immediately, no. It looks like a challenging second half of the year for the auto segment based on those factors.
Okay, but it wasn't all challenging news. There was a definite bright spot, wasn't there? The energy division.
Absolutely. Energy had a standout quarter, really strong performance. They hit a record for energy storage deployments, 9.6 gigawatt hours. That's huge. And importantly, it posted its highest gross profit ever. Margins improved from Q1 as well. Powerwall home battery deployments also hit a new record.
That's impressive, especially given it faces presumably some of the same tariff and supply chain issues as the auto side. How do they manage that?
It seems like the underlying demand is just incredibly strong, particularly for the big industrial scale megalith batteries. It sounds like those large customers are more willing or able to absorb the tariff-related price increases, unlike maybe individual car buyers.
Interesting. So commercial demand is robust?
Very. Though they did flag a potential headwind coming for residential storage, some consumer credits might expire early, so not totally immune. But stepping back, what this really shows is the energy segment becoming, an increasingly vital strategic hedge for Tesla. It's a solid, profitable growth engine, and it's tied to different long-term trends than the car market. It provides some balance.
Okay, so that brings us to the really big question. You've got this core auto business facing serious headwinds. You've got a growing energy business. But how does all that justify Tesla still having this, trillion-dollar plus market cap? It can't just be cars and batteries, can it?
No, it really can't. And the answer ties directly back to those massive long-term bets on AI and robotics we talked about. That's where the valuation story lives. That huge CapEx spend, over $9 billion this year. That's the evidence. It's buying literally tens of thousands of those advanced AI chips for their Dojo supercomputer. It's building a whole new dedicated AI factory. They say production starts late next year. And of course, it's pouring money into R&D for Optimus, the humanoid robot.
Right, Optimus. Musk called it potentially the biggest product ever. Big words.
Huge words. And the timeline he laid out is just, astonishingly fast. He talked about having Optimus version 3 prototypes ready within 3 months.
3 months for version 3.
That's what he said. Yeah. And then starting production early next year with a, quote, medium confidence target of ramping up to making 100,000 robots per month within 5 years.
100,000 a month. That's a mind-boggling scale for something that barely exists in prototype form now.
Exactly. And that's why you have to see Optimus, for now at least, largely as a valuation narrative product. Its main job today is to help investors reframe Tesla, not as a car company, but as a general-purpose AI company. That's how you justify a valuation way beyond traditional automakers. I saw one analyst estimate the core auto business might be worth, say, $200 billion.
Implying the other $800 billion or more of the market cap is pinned on these new toys, like AI, FSD, Optimus.
Because the potential market for something like Optimus, think about the future of labor, is arguably orders of magnitude bigger than even the entire auto industry. It's about that potential.
So let's try and wrap this up. You've got the official story from management. This is a seminal pivot, moving towards a future of high-margin AI, software, robots. But the current reality, a core auto business facing pretty severe margin pressure, demand questions after the tax credit repeal, and notably, no specific guidance on how many cars they expect to sell for the rest of the year.
Which definitely puts the spotlight on the risks tied to their own ambitious outlook. Let's just list them out quickly. Robotaxi, huge execution risk, massive regulatory hurdles, missing those half the U.S. by year-end or personal cars next year. Deadlines could really hurt credibility.
Right.
Full self-driving is true. Unsupervised autonomy actually feasible technically anytime soon. We still don't know. And those regulatory approvals in Europe, the Kafka-esque ones in China, totally uncertain timelines out of Tesla's hands.
Okay, what else?
The new car models, the affordable one is ramping slower, delaying that potential volume boost. And the unboxed manufacturing for the Cybercab in 2026, that's a new process, carries risk.
And Optimus.
Optimus. I mean, the timeline is just extremely aggressive for something so complex, technically and manufacturing-wise. Commercial viability, actual market demand, it's entirely speculative at this point.
And underpinning all this future vision is the massive spending.
Exactly. That $9 billion plus CapEx this year just eats up nearly all the cash from operations, leaves very little free cash flow, less financial cushion.
Plus the headwinds we already discussed hitting the current business.
Yep. More tariff costs possibly coming, the hit from the IRA credit ending, energy credits phasing out, regulatory credit revenue drying up. It's that pincer movement again, squeezing margins in autos and maybe energy too in the second half of 2025. And they haven't really pointed to any clear offsetting good news or tailwinds.
So it really leaves you, the listener, with this central debate to mull over, doesn't it? Is Tesla fundamentally still a high-volume EV maker just dealing with the tough parts of that industry cycle right now? Or is it truly this nascent AI and robotics platform right on the verge of unlocking completely different, maybe stratospheric levels of value?
And the crucial question, the one that hangs over everything, is this. Can the tangible profits from that AI and robotics vision from FSD, Robotaxi, Optimus actually show up? Before the tangible pressures on the existing automotive business become just too overwhelming, this quarter, Q2, really felt pivotal, like management said. And the next few quarters, they're going to be critical in seeing if Tesla can actually bridge that gap, the gap between its challenging present and those really extraordinary ambitions.
A fascinating story to keep watching. Definitely keep exploring this one.